Good morning, traders. Today is February 11th, early morning Saturday in California. This is Brad Matheny. Today, we're going to go over the MENT Rotational Modeling System and the U.S. real estate custom modeling indexes that I create. I want to remind you first to please visit MENT.com Technologies. Support me in my research and my efforts to try to help you become better traders. Remember, I do all of this research for you to help you manage and protect and grow your wealth over time. The goal is to provide you custom proprietary research you can't get anywhere else and help you become a better trader. Everything is contained in one membership called the Expert Growth Membership. You get all of my research in all of this detail in one membership, and prices are relatively inexpensive. I started charging this year because I really need to make this into a business to try to support you. Remember, I'm dedicating my weekends to try to do this. Again, it is Saturday. I have about 9 hours worth of work to do today in getting all of this done for you, and I'm trying to keep it as efficient as possible, doing it once a week and then supporting you throughout the week to be able to be prepared for what's coming. Follow my research. If I'm helping you, support me in trying to grow my tools and expand my tools to provide you greater research. I believe I'm giving you the best research that you can get pretty much anywhere on the planet. And I challenge you to try to find anybody who can do what I do as efficiently as I do. Okay, now let's get back to the chart. I just got done doing the TT Scanner hot list video. And now we need to focus on the reality of the fact that we are still in a sideways flagging formation. We could potentially move downward over the next week or two, possibly sideways, trying to find some support. Ideally, though, I believe we're going to be continuing to bias to the upside, meaning the markets will resolve back into an upward trend unless there's some major crisis event and target this 425 to 435 area on the SPY. That's this blue line here that I've drawn. And I believe this is the ultimate structure in price. Now, I've drawn this big yellow line over here. In fact, I'll edit this, make it a different color. The purpose behind this line is to show you and to provide you with a control that shows us where the actual upward trend will breach a hypothetical price line in the sand. So understand that we are in a wave one impulse wave to the upside, all the way up, potentially just as I've drawn these lines here. In fact, let me try to move this, highlight it a little bit. Long and short of it, this is our upward trend. And I believe we are going to continue to resolve in this trend, staying above this line right here. And I believe as long as we stay above this line to the upside, we are still in a wave one formation. We would have to get below this line, would not indicate that we are in a new bearish trend. It would indicate that we are in a bearish pullback of a bullish trend. And I believe as long as we stay above this support channel all the way up, we are going to be in a wave one formation of a broader wave five. So I believe we could see a wave one cycle be A, B, C up to here, possibly A, B, C, D, minor E, followed by a pullback in end of April, May, June, July, bottoming possibly in late June, July, and then beginning a new rally phase, which would be wave C, ending possibly up into this 465, 470 area, hypothetically, followed by a broader pullback. And this could be the beginning of a wave two pullback, which would extend potentially to the new wave C of the wave five formation, broadening even higher, reaching new highs and extending up above 525, 535, possibly even 550 on the SPY. So ideally, ladies and gentlemen, the opportunity for us is between now and this peak. We have about a 6.5 to 7% upside opportunity in the SPY. Then we need to wait through this pullback, possibly looking at the inverse TT Scanner hot list to try to short some symbols or get in inverse ETFs. then looking around early, end of June, early July for an opportunity, which would be a 12.5% rally phase, potentially in the SPY. And this is where I believe the real opportunity for growth is. This is going to be moderate when you consider this range over the next 5-6 months. What we're looking at here, ladies and gentlemen, is a broad sideways formation, possibly 6, 7, 8% up, possibly 8, 9, 10% down, possibly another 6, 7, 10% up. This is basically 8, 9 months of sideways trending where we are not going to have a whole lot of opportunity, and you need to be very targeted in your trading. Okay? After this June, July base sets up, which is, again, hypothetical, I believe this is the right timing and structure, then we have a real opportunity for a big broad phase to the upside. Could go even a bit further. Could come back up to these highs, right back over into this area, and potentially stall out. But then we're going to get into the wave 2 correction. This is, again, one big wave 1, wave 2, and then wave 3 up to the upside. This is where we need to prepare for our load up over here of the next big phase to the upside. This is clearly an upward trend. We've got to get above this high to initiate some upward trending. If we move just like I suggest here and then pull back down back into this channel area, 430 to 440, maybe 445, this is going to be our load up area, and that may be in the mid 2024 before that actually happens. So we need to stay very cautious. We have some good opportunities here if my analysis is correct, which is why, ladies and gentlemen, the MENT Rotational Modeling System is set up as we are. We are bullish on the SPY, which indicates that we would be 50% into trading stocks, 25% into cash, 25% into hedging in metals, or alternately 65% stocks, 35% cash. These will move as we move into the broader bias to the upside. After this correction in April, May, June, we will likely become more aggressive here. Overall, the MENT Rotational Modeling System is bullish on the weekly with 25% allocation, bullish on daily with 75% allocation, and overall, if it's a single position, you would be bullish 100% of your retirement or 401k into allocation into bullish stocks, tracking the SPY or the QQQ. We are basically back into a bullish trending mode right now for the SPY. And that puts us net right now since our last trigger of minus 0.86%. Overall, with the dual account, we are plus 27.78% on our weekly 25%, and we are minus 0.86% on our 75% allocation. And this is the model that I track, the dual modeling system. This is basically two accounts trading 75% and 25% of our allocation, 25% for weekly and 75% for daily. And again, this is the tracking of that dual modeling system. You can see here that we have come back up to near all-time highs now. We've caught this move very, very well. We need to just see what happens here. If we get that melt up to the upside, like I was mentioning, this system, the MENT Rotational Modeling System, will push to new all-time highs, which will be fantastic. We'll have grown our account from 100,000 in January 1996 to over 2 million by 2024. So that gives you an example of, do the math. So here's 10 years, here's 20 years. This is about 30 years. You'll be looking at about a 2,100% growth factor with the MENT Rotational Modeling System. Quite impressive when you think about it. Okay, right now, as of today, as of Friday, 2023 is up 0.05%. Not huge, but we're getting there. It's still very early in 2023. Okay, so now let's go through the real estate. So the data was updated just last week, and make sure I have the right data here. This is last week's or a couple weeks ago. So let me come back over here and copy the data. is it? Here, here, and here. And should have grabbed these earlier. Sorry, guys. So let me come back here and back here. Okay, let's see if we have this. There we go. Okay, now we have the data in place for the new month. This was just last week's updated data. You can see here, now let's go ahead and take a look at this. Huge increase in price reductions, huge increase in new real estate active listings, huge increase in median days on market, huge, continuing, I should say, decrease in median listing price, and we're getting a large number of shares reduced. Now, we are seeing model market demand start to tick up. We are getting back up into this positive territory. I believe this is just simply buyers and institutions coming in to try to accumulate some real estate. You can see it's not making much of a dent in active listing counts and or days on market. Days on market are staying quite a bit higher than we've ever seen before. Again, back over here, the peak around COVID, we're back into those COVID peak levels near the absolute bottom of the market for COVID. I believe these could continue to move higher. And I believe this demand modeling system is showing an uptick in demand. You're seeing some houses being sold, buyers coming in and trying to acquire what they can, knowing that the Fed may have to push rates a bit higher. But I need you to understand that actual pricing factor is still at negative. So we've had a plus 5% week over week change in pricing factor, and we've seen a plus 12% in model market demand. This is telling us that essentially things are kind of basing and bottoming. I believe these are going to roll over very hard if we start to get more data, and I'll show you why. Okay, now let's go over to the next data. Real estate pricing trends. Flatlining, slightly up. And again, this is telling us that we're seeing a little bit of price appreciation. This is more than likely homes coming on the market that are still trying to, target a moderately high price level. You can see price reductions are now inching up to the 150% area. Very scary with regards to price reductions. Reduction activity is still up in the 40-50% area. Number of active listing count change, you can see it's rolling over. It's getting very broad here. So this is really real estate active listings change. We've peaked again. We've got some new listings coming in here. It's stalling back out. It'll probably stall back out here at -4, -5 over the next week or two. And then I think we're going to see it shoot higher, meaning we're going to see a lot of new listings come on the market. As I understand it, there's a number of people that are having trouble right now. HUD has come out and attempted to initiate a new homeowner assistance program for everybody who was speculating, has been trapped in this market. Potentially even those who may have gotten into adjustable rate mortgages or were involved in Airbnb or short-term rentals. Understand that the dynamics of the markets have changed, and people are just not spending like they used to spend, and it's going to start to bite people in the rear end. So now we have new listing count metrics. You can see the new listing counts up at 79.3. Highest number we've seen over the past literally 4 years. This is a huge number for number of active listings that are coming on, and I think this is going to keep going up. New listing count change was a little bit contracted last week, and new share of market was a little bit contracted last week. We're seeing this. This is a modeled system, so we need to see how this plays out. But the fact that we have these inventories stacking up, what this is telling you is that inventory is just not moving. So the heat rank index, just as I mentioned, had collapsed. We're back down into negative territory. This is telling us that the market is weakening rather substantially. It's not collapsing like we saw back over here, but it could move into an aggressive collapse mode. The tightness rank has gone back up above 0 last week. This is essentially showing us that some measured activity is tightening back up. So the market is tightening up while the heat rank is dropping. Real estate inventory strength, this is telling us the actual amount. So think of that as demand. Think of it as running a retail store, and if your inventory is strong, you can't keep things on the shelf. Okay, if your inventory is weakening, then it's still selling, but it's kind of stacking up. You're not seeing the same sales volume and demand volume coming in. So we're seeing tightness tighten up moderately. Heat rank is diminishing. Inventory strength is diminishing. That's telling us that essentially we're looking at a new wave down. And this is where I believe we're going to shift probably by June, July, August into a negative year-over-year pricing for real estate. And you can see here the seller desperation index has inched back up. Sellers are starting to get very aggressive. If you want to try to sell your home, you're going to become very aggressive. I believe this is going to start to become measurably stronger over time. So real estate is at that crux point. And I want to highlight this by showing you this chart right here. This is my custom real estate hostility index. Even though the last couple of weeks we had seen this come back down to the downside, meaning that the markets were losing their hostility edge. Think of it as this becomes a very hostile market. This becomes a very aggressive and friendly market for buyers. So you can see here the peak in 2007-8, we moved into hostile territory. We moved back down into a friendly territory. We moved back up into moderate, hostile, friendly, now hostile, now friendly, now hostile, now friendly, now hostile, now friendly, now extremely hostile. I really believe we could be setting up with a broad collapse in real estate back down into this friendly mode. And I believe, as you can see here, house pricing, it's just going to take another couple of months, ladies and gentlemen, and we're going to move into year-over-year downward trending. And I hate to say it, but depending on how things work out, we could be looking at a 2026, 27, 28 decline in real estate after Fed, gets done moving their rates and aggressing this extremely hostile environment. This could push house prices from this point, which is almost 400, back down into this 270 to 310 area. And that would be, again, a 35% decline in pricing. We could even go down into this lower territory if things become extremely aggressive. Okay, so let's go back over here. We are looking at the accumulation cycle phase. This is the stock market. We're going to pay attention to right now. We're kind of basing into this mode, looking for a wave, the beginning of a wave 5 rally. We are seeing this hold up very well into downward diminishing cycle, accumulation cycle phase. This is what we want. We are seeing some rotation here, which is what we want. We want to see this move downward. This is on this accumulation phase index. This is the SPY. As long as this continues to flatline and move downward, the upper bias is still solid. If this moves back to the upside, then we're going to be looking at a broad downward cycle trend, meaning the markets are going to be preparing for another downward cycle phase. Right now, it looks like we're holding up very well for a wave 5 rally phase, okay? Next, we have the fear index has moved down to 5.48. This is the SPY moving higher, stalling a bit this week. And this is my custom market sentiment index, is stalling right near flatline. This is ideally kind of what we want. We want to see this continue to stall out in this middle channel area and then eventually try to move into that wave 5 rally phase to the upside. That would mean the SPY would attempt to move into the 430, 440 area, potentially, then eventually by the end of 2023 into 2024, maybe be up in the 470, 475 area, trying to break to new highs. Right now, everything is tracking very well for an upside bias to continue. We do not see any crisis events setting up other than the fact that real estate may unwind. It would probably behoove the Fed to move into kind of a consolidated mode, meaning the last 25% rate increase was solid. Maybe another 25% rate increase but then possibly moving into kind of a bias, possibly even at some point moving rates downward to take a little pressure off the market. The real estate market, once it shifts direction again here, once it shifts downward, this trending will likely continue. Even when the Fed drops rates to zero, this cycle phase will likely continue until we get down into these lower channels, making the real estate market very opportunistic again. So understand that these cycles, these boundaries, think of this as hostile, think of this as friendly. We need to get down into this friendly territory, and that means we got to get down into this area from where we're at 424 down into potentially 224. That's a 50% decline, maybe more. A 50% decline here would put house prices potentially down in the 220, 240 area from where they're at right now at about 380, 390. Okay, next we have the U.S. Custom to global market. This is the global market here. We've rallied back up. This is a good solid wave 1 of wave 5 rally. Same thing here. We've broken the resistance channel. Now I think we stagnate. We basically consolidate and stagnate for the next 4 or 5 months, maybe attempting to get up into this area in the U.S. market, breaking above this high, maybe getting above this high in the global markets, and then consolidating kind of in this midpoint area, like right over in here and or right over in here near where this green line is. And that's kind of where I think we're going to be in April, May, June. We're going to be back up in this area, rolling around for a pullback, looking for the next wave higher, assuming that nothing breaks. Okay. Next, we have the U.S. Valuation Trend Index, basing and bottoming. This is a very key indicator telling us that we're not seeing any real volume or valuation appreciation in the U.S. stock market. In order for the U.S. stock market to move into real upward trending, we need to see this start to move to the upside. So again, we're not seeing that yet. And this is very key to understand. That's why we need to stay cautious. We need to stay aware of the trending. We are not seeing upward confirmation on the valuation trend index, which is critical to our understanding of consumer engagement and how healthy the economy is. Right now, the economy is basing, bottoming, trying to find a base, trying to find a bottom, trying to get some momentum to the upside, and we are not seeing that yet. So we need to be very aware that risks are still elevated. That means you need to be very cautious moving forward and follow my research. Okay? I think that's the last chart. Oh, one more. Oh, no, we go back into the rotational modeling. Okay, so remember, follow the rotational modeling system. This is really the key to everything that I do. Okay, everything I do, this tells us what we're doing and how we need to be protected from the markets. Then use my custom indexes like this to be aware of how the markets are reacting internally. This is telling us that we have a huge obstacle to still overcome. We are not seeing upward momentum. We are not seeing upward bias. We need to see this start to move to the upside to actually see that we're in a broad market upward cycle trend. Without seeing this move to the upside, we need to stay very cautious. Think of it as still 50-50. We're starting to see some early trends to the upside. The rotational modeling system has gone bullish, but we are seeing no confirmation in the valuations trend index, which is really important, ladies and gentlemen. We could see another 8, 10, 12 months of sideways activity that could be very difficult and very choppy. All right, guys, off to the next video.